Hello, welcome to Capital Sensei. Today we're going to dive deep into one of the most reassuring ideas in the world of investing, summarized from a true classic, Conservative Investors Sleep Well by the legendary Philip Fisher. We'll explore what it really means to be a conservative investor. Not in the sense of being fearful, but in the sense of being so well prepared that you can rest easy. We'll break down his 4 essential dimensions for picking a great company, uncover his famous Scuttlebutt research method, and even discuss his surprising advice on when you should, or more importantly, when you shouldn't, sell a stock. As we go through these ideas, you'll likely have questions or experiences of your own. We do our best to answer questions in the comments. So please, feel free to share your thoughts, your doubts, and your own investment stories below. Creating a community where we can all learn from each other is one of the best ways to grow as investors. So, who was this Philip Fisher? Think of him as one of the grandfathers of modern investing. He was active around the same time as the more famous Benjamin Graham, who was Warren Buffett's teacher. But while Graham was a numbers guy, obsessed with buying cheap stocks based on their balance sheets, Fisher was more of a business detective. He wasn't looking for a cheap bargain. He was looking for an absolutely outstanding business that he could own for a very, very long time. His most famous book is probably Common Stocks and Uncommon Profits, but Conservative Investors Sleep Well really gets to the heart of his philosophy. The title itself is a masterclass in psychology. It perfectly captures the goal of this style of investing. It's not about finding some obscure stock that might shoot up 1,000% overnight, giving you heart palpitations along the way. No, this is about finding companies so solid, so well run, and with such a bright future that you can buy their stock, turn off the financial news, and not lose a wink of sleep over what the market does tomorrow, next week, or even next year. The conservative part isn't about avoiding risk. It's about eliminating unnecessary risk through deep, fundamental knowledge. Fisher's entire approach can be boiled down into what he called the 4 dimensions of a conservative investment. Getting these 4 things right is the foundation for sleeping well. Let's break down the first one: superiority in production, marketing, and research. It sounds a bit corporate, but stick with me, it's actually very intuitive. It's about finding a company that is simply better at its core business than its competitors. Let's start with production. Fisher argued that a conservative investment should ideally be with a company that is the lowest cost producer in its field. Imagine 2 coffee shops on the same street. One shop has old, inefficient machines and a disorganized supply chain. It costs them $3 to make a single latte. The shop across the street has state-of-the-art equipment and buys its beans in bulk, so it only costs them $1.50 to make the same latte. If a new competitor opens up and a price war starts, which shop has the power to lower prices and still make a profit? The second one, of course. Being the low-cost producer gives a company a massive competitive cushion. Next in this first dimension is marketing and sales. This isn't just about clever commercials. It's about having a truly superior sales organization that understands its customers and has built a powerful distribution network. A company can make the best product in the world, but if it can't get it to the people who want to buy it, it doesn't matter. Think about a brand like Coca-Cola. Their marketing is legendary, yes, but their real power lies in their distribution. You can find a Coke in a remote village on the other side of the planet. That kind of reach is incredibly difficult for a competitor to replicate. The final piece of this first dimension is research and development, or R&D. Fisher believed that a company standing still is a company that is dying. A conservative investment must be in a business that is dedicated to improving its products and developing new ones. Think about the pharmaceutical industry. A company might have a blockbuster drug, but patents expire. If that company isn't pouring money into its labs to find the next blockbuster drug, its future is bleak. A commitment to R&D is a sign that the company plans to be a leader for decades to come, not just for the next few years. So, to recap the first dimension, you're looking for a 3-in-1 winner. A company that can make its products cheaper, sell them more effectively, and is constantly innovating to stay ahead. A company that nails all three of these is already a strong candidate for an investment that lets you sleep well. Now, for Fisher's second dimension, and this one is arguably the most important, the people factor. Fisher was adamant that a company is only as good as the people running it. You can have a fantastic product in a booming industry, but if the management team is incompetent, dishonest, or short-sighted, the business is destined for trouble. Investing in a company is like handing over your money to its executives and saying, "Here, grow this for me." You'd better be sure you trust who you're giving it to. What does great management look like? It starts with integrity. Are the leaders honest with their shareholders, their employees, and their customers? Do they admit their mistakes, or do they try to sweep them under the rug? You also want to see competence and a deep understanding of the business. But more than that, Fisher looked for a management team with a long-term perspective. Are they focused on building something that will last for generations, or are they just trying to pump up the stock price to meet their quarterly bonus targets? A focus on short-term profits at the expense of long-term health is a huge red flag. How on earth do you judge something as subjective as management quality? This is where the detective work begins. You can start by reading the company's annual reports, especially the letter to shareholders from the chief executive officer. Does it sound like a boilerplate marketing document? Or does it offer a candid, insightful look into the company's challenges and triumphs? Watch interviews with the CEO. Do they seem passionate and knowledgeable? Or are they just spouting corporate jargon? Great leaders have a way of inspiring confidence that you can often feel, even through a screen. Think of it like this. If you were going to partner with someone to open a restaurant, you wouldn't just look at their resume. You'd spend time with them. You'd want to know their work ethic, their passion for food, how they treat their staff. Investing in a company's stock is entering into a long-term partnership with its management. You need to be just as discerning. Neglecting the people factor is one of the fastest ways to turn a seemingly conservative investment into a nightmare. Let's move on to the third dimension, favorable business characteristics. This is about the nature of the business itself and the industry it operates in. Even with great products and great people, some businesses are just fundamentally more attractive than others. A key concept here is what economists call barriers to entry. A business with high barriers to entry is like a castle protected by a wide, deep moat. It's very difficult for new competitors to come in and attack its profits. Let me give you an example. If you wanted to start a new social media app, the barriers to entry are relatively low. You need some skilled coders and a good idea. It's hard, but it's possible. Now, imagine you wanted to start a new railroad company to compete with an established giant like Union Pacific. The barriers to entry are astronomical. You would need tens of billions of dollars to buy the land, lay thousands of miles of track, and purchase a fleet of locomotives. It's practically impossible. Companies with high barriers to entry enjoy a protected status that makes their future earnings far more predictable and secure. Another favorable characteristic is high profit margins. A profit margin is simply the percentage of revenue that a company keeps as profit. A company with high profit margins has a lot of wiggle room. Let's go back to our coffee shops. If the efficient shop sells a latte for $4 that costs $1.50 to make, its profit is $2.50. That's a great margin. If the inefficient shop sells the same latte for $4 and it costs them $3 to make, their profit is only $1. If the price of coffee beans suddenly goes up by 50 cents, the inefficient shop might start losing money, while the efficient shop is still comfortably profitable. High margins are a sign of a strong competitive position and a healthy business. Fisher also looked for businesses that were not overly susceptible to government regulation or price controls, as these can suddenly and dramatically change a company's fortunes. He wanted businesses that had some control over their own destiny. In essence, this third dimension is about finding a company playing a game that is tilted in its favor. It's in a great industry, it's protected from competition, and it's highly profitable. This adds another thick layer of safety to your investment. We've covered the company's products, its people, and its business model. Now we come to the fourth and final dimension, which brings it all together for you, the investor: the price of the investment. This is critical. Fisher's philosophy is not about buying great companies at any price. Even the most wonderful business in the world can be a terrible investment if you overpay for it. This is a point that many enthusiastic investors, especially in booming markets, tend to forget. Imagine finding the perfect house. It's beautifully built, in the best neighborhood, with great schools and friendly neighbors. It's a 10 out of 10 property. The fair market value for this house is $500,000. But the owner, caught up in a housing frenzy, is asking for $1.5 million. Would it be a good purchase? Of course not. Buying it would be a financial disaster. No matter how wonderful the house is, the same exact logic applies to stocks. So how do you know if the price is reasonable? This is where some financial analysis comes in. Looking at metrics like the price-to-earnings ratio, or PE ratio, and comparing it to the company's growth prospects and its historical valuation. But the core idea is simple. You are looking for a disconnect between the company's long-term value and its current stock price. The best time to buy these fantastic companies is often when the market is pessimistic or fearful. During a market downturn or a recession, the stocks of even the best companies get beaten down along with everyone else. This is when the patient, conservative investor who has done their homework can step in and buy a piece of that wonderful house at a fair or even a bargain price. This discipline of waiting for the right price is what truly makes the strategy conservative. It prevents you from getting caught up in hype and euphoria. It forces you to be patient and rational. Finding a great company is only half the battle. Buying it at a price that provides a margin of safety is the other half. Getting both right is the ultimate key to sleeping well at night, knowing you own a wonderful business that you bought for a sensible price. Now, you might be thinking, this all sounds great, but how do I actually find out all this information about a company's production costs, its management's character, and its competitors' weaknesses? This leads us to one of Fisher's most famous and unique contributions to investing, the Scuttlebutt method. The word scuttlebutt is old naval slang for the cask of drinking water on a ship, where sailors would gather and exchange gossip. For Fisher, it meant doing on-the-ground, investigative research. It meant talking to people. The Scuttlebutt method is about going far beyond the glossy annual reports and the official company press releases. These documents are useful, but they are marketing materials designed to present the company in the best possible light. To get the real story, you need to talk to the people who interact with the company from every angle. It's like being a journalist or a detective, piecing together a mosaic of information to get a complete 360-degree view. Who do you talk to? Fisher suggested a wide range of sources. You could try to talk to a company's competitors. Ask them, who do you respect most in this industry? What are Company X's greatest strengths? What are their weaknesses? Competitors often have a very clear-eyed and unsentimental view of each other. You could also talk to the company's customers. Why do they choose this company's product over others? Is it the quality? The price? The customer service? Are they happy? Would they switch to a competitor if the price went up 10%? Their answers can reveal a lot about a company's competitive advantage and pricing power. The list goes on. Talk to the company's suppliers. Does the company pay its bills on time? Are they a demanding but fair partner? Suppliers can give you insights into a company's financial health and operational efficiency. You could even try to talk to former employees. Why did they leave? What was the culture like? This can be a goldmine for understanding the people factor we talked about earlier. Even university researchers or trade association executives who specialize in that industry can provide invaluable context. Now, let's be realistic. For the average individual investor, calling up the chief executive officer of a competitor might be a long shot. But the principle of Scuttlebutt can be applied at any level. You can read trade journals for that industry. You can go to online forums where customers discuss the products. If you're researching a retail company, go visit their stores. Observe the staff, the customers, the cleanliness. Is it a vibrant, well-run place, or does it feel neglected? This hands-on research is the Scuttlebutt method in action. It's a lot of work, but this is precisely what builds the deep conviction needed to hold a stock through market turmoil, and yes, to sleep well. After all this work, analyzing the 4 dimensions, doing your Scuttlebutt research, and finally buying a wonderful company at a reasonable price, the next big question inevitably arises. When should you sell? This is where Philip Fisher's advice becomes truly radical and departs from the thinking of many investors. His answer, in short, was almost never. That's right. If you have successfully identified a truly outstanding company that meets his stringent criteria, Fisher believed that the single biggest mistake most investors make is selling it too soon. People get nervous when the market drops and sell out of fear. Or, perhaps even more commonly, they sell after the stock has had a nice run-up to lock in their profits. Fisher saw this as a massive error. He argued that finding a truly great company is an incredibly rare and difficult thing. Once you've found one, why on earth would you sell it just to try to repeat that difficult feat all over again? The odds are you'll make a mistake on the next one. He famously said that if you did your homework correctly when you bought the stock, the right time to sell it is never. Of course, he qualified this. There were 3, and only 3, valid reasons to sell a stock. The first reason is if you made a mistake in your original analysis. You go back over your research and realize the company was never as good as you thought it was. Perhaps its competitive advantage was weaker or its management less capable than you believed. In that case, you admit the error, sell the stock, and learn from the experience. The second reason to sell is if the company has fundamentally deteriorated and no longer meets the original criteria you bought it for. Maybe there's a new management team that is destroying the company culture. Perhaps a new technology has emerged that makes the company's main product obsolete, and they have failed to adapt. The business is no longer the great business you initially bought. In this case, the reasons for owning it are gone, so you should sell. The third and final reason is a very high bar to clear. you have found a demonstrably and significantly better investment opportunity elsewhere. It's not enough to find a company that is just slightly better. The new opportunity must be so compellingly superior that it justifies selling the wonderful company you already own. This is rare. For Fisher, the default action was always to hold on. He believed that the real money was made by holding on to great growth companies for years, even decades, and letting the power of compounding work its magic. To bring all these concepts to life, let's try to apply Fisher's framework to a modern, well-known company. This is just a hypothetical exercise, not investment advice, but it helps to make the ideas concrete. Let's take a look at a company like Costco. First, the 4 dimensions. Dimension 1, production, marketing, and research. Costco is a master of low-cost production. Their immense buying power allows them to get incredible deals from suppliers. And their no-frills warehouse model keeps overhead low. Their marketing is genius. The membership fee creates a loyal customer base and a massive recurring revenue stream. Their research is constant, as they meticulously curate their product selection to offer high-quality goods that their members want. Dimension 2, the people factor. Costco has a legendary reputation for treating its employees exceptionally well, paying them high wages and offering good benefits. This leads to very low employee turnover and famously helpful, happy staff in their stores, which enhances the customer experience. Its management, from its founder Jim Sinegal to his successors, has consistently maintained a clear, long-term focus on providing value to the member above all else. Dimension 3, favorable business characteristics. The barriers to entry are huge. Replicating Costco's global supply chain, its network of strategically located warehouses, and its 90+% membership renewal rate would be astronomically expensive and difficult for a new competitor. Its business model of high-volume sales with thin product margins, but high overall profit from memberships, is a fortress. Dimension 4, the price. And here is where the work for a modern investor comes in. Costco is, by almost any measure, a fantastic company. But is its stock trading at a reasonable price today? Its price-to-earnings ratio is often quite high, reflecting the market's admiration for the business. A strict Fisher disciple would analyze its valuation carefully and might decide to wait for a broader market downturn or a period of temporary pessimism about the company to buy the stock at a more attractive price. The quality is there. The question is the price. This exercise shows how Fisher's framework isn't a simple checklist. It's a way of thinking, a deep dive into the soul of a business. It requires patience, diligence, and a focus on what truly matters for long-term success. It's about looking past the daily noise of the market and focusing on the underlying quality of the business you are becoming a part owner of. Ultimately, the lesson from Philip Fisher and Conservative Investors Sleep Well is a profound shift in perspective. It moves investing away from speculation and gambling and transforms it into the discipline of business analysis. It teaches that your goal isn't to outsmart the market on a daily basis. Your goal is to identify a handful of truly exceptional companies, run by trustworthy and capable people, buy them at a fair price, and then have the patience and fortitude to hold on, letting them grow and compound your wealth over time. This path requires more upfront work than simply buying a popular index fund or chasing a hot stock tip. It requires curiosity, critical thinking, and the willingness to be a patient detective. But the reward, as the title so perfectly promises, is not just the potential for financial success. It is the peace of mind that comes from knowing you own a piece of a high-quality, durable enterprise. A conservative investor in Fisher's world isn't someone who is afraid of losing money. It's someone who has done the hard work necessary to conquer that fear with knowledge, allowing them to truly sleep well at night.